Hi everyone. Okay, in this video we're going to be taking a look at problem 6-38 in which you have two requirements. And it's going to look a little more daunting than it actually is. There you have a listing of several transactions, I think about 10 or 11 transactions. You really don't have to do and pay attention to most of them. So I'm going to go through what we have to actually do is the FIFO calculation, just like we did in the previous problem. So I'm not going to review how to do FIFO again. I just want to point out a couple of things. So in this particular problem, you're going to be looking at transactions that have to do with purchasing inventory or selling inventory. So for instance, on January 2nd, it says completed a consulting engagement and received cash of $5,700. You can ignore that transaction. There's nothing that affects inventory on that, so you don't need to do anything with that particular transaction. So what you're going to be looking at are transactions such as on January 7th, January 18th, January 22nd, January 28th, and January 31st. Those are the transactions that you want to pay attention to because those are the ones that are affecting inventory. And what we're going to do in this problem is on requirement 1 is you're going to do a calculation for your FIFO. So again, you want to review the video that I posted for how to do FIFO, first in, first out. But I do want to point out a couple of things that you'll need to know for this particular transaction that's different than in the original, in the transaction from the FIFO calculation before. So again, you have the same type of thing where you're going to have your purchases, where you're going to be listing your quantity, your unit cost, and your total cost, your cost of goods sold, quantity, unit cost, and total cost, and then your inventory on hand, quantity, unit cost, and total cost. Now you might be asking, well, what is our inventory on hand? We're starting with 0. So our first inventory on hand is going to come about as a result of the purchase of 50 units on January 7th. So you're going to just list your purchase of your quantity on January 7th, your unit cost, and your total cost. Now this is a little bit different from the previous problem in that it doesn't tell you what the unit cost is. So you have to actually back into that unit cost. So it tells us that we purchased 50 units of software inventory on account for 1,050 plus freight in for 50. So what you have to do is take your total cost and divide it by the quantity to come up with your unit cost. Now you'll notice that at the bottom of this, there are some places that you can do those calculations. So you want to calculate what is the unit cost for January 7th. So again, you want to take your total cost divided by your number of units to come up with your unit cost. Now, a hint here, you want to add in the freight in of $50 for your total cost. If you don't, you're going to get the wrong unit cost. So make sure that you add in the $50 freight in to what they purchased the units for in order to come up with your total cost. And then January 22nd, there's another purchase, and all you do is take the total amount that they purchased the units for and divide it by the number of units to come up with your unit cost. So that's just a hint there. Your cost of goods sold, you're going to record, for instance, on the 18th, when they sold 40 units of software on account for 2,625. So again, you're going to know your unit cost because you calculated that back on January 7th. I think that is, the other thing I do want to mention is that on January 31st, you'll notice that there's 4 adjusting entries. Now again, you only have to really be concerned for this problem on the physical count of software inventory of 50 units. What you're going to record on January 31st is what is actually the discrepancy. Because at the end, when you're calculating this, you're going to come up with an inventory on hand on January 28th. You're going to come up with a certain number of units on hand that the system has taken care of every time you recorded a purchase or you sold inventory. But if you've read the chapter, then you know that they also do a physical count at the end. And sometimes the physical count is different than what we have recorded, in our records. And so you have to account for that. And that's what this transaction on the 31st does. It's recording the difference between what we have on hand on the 28th, according to the records, and what we actually physically count. So when there's a discrepancy like that, you have to actually consider it. When you find that there's a discrepancy of however many units, you have to consider that you actually did sell those that for some reason they weren't recorded. So here you're going to record a cost of goods sold for the difference in the number of units on hand compared to what we have recorded on hand, and you're going to record that at the most previous unit cost. So whatever your last your unit cost was that you calculated for the 22nd is the unit cost that you're going to use. So again, on the 31st, you're recording. You're going to see that there's a difference between what we have on hand on the 28th, according to our records, and what the physical count says. We now have to consider that to be sold, that we just didn't record it, and you record it at the last unit cost that we calculated. Okay, now the second part of this, forgive me if I can get to this. Give me a second here. Sorry about that. Requirement 2, you're going to be doing just 3 entries. You're going to journalize the transactions for January 18th, for January 28th, and for January 31st, Part D. You're going to journalize those transactions. So what you have to do, every time we sell units, we have to record both the sale and the effect on our inventory. So you want to go back to the chapter. There's always going to be, for this 18th and the 28th, whenever we have sold, you're going to have to record the sales revenue, and then you're going to also have to record the effect on inventory. So you're going to have 2 separate different entries for the 18th of January and for the 28th of January. You're going to have to record the revenue that you earned by the sale, and then you're going to have to record the cost of inventory, the change in inventory, and the cost of goods sold. Now the 31st will be different in that we're not going to actually record a sale, because what we've done is that we have actually seen that our records are different. So we don't record a sale in that particular case, we just record the effect on cost of goods sold and inventory. So I hope this helped to explain it a little bit and to help you to know what to do for this particular problem. Thanks so much. If you have any questions, please give me a call.